Good morning, everyone. We'll make a start now. Thank you for joining us on this webinar today as we look to discuss employee incentivization, specifically how to reward employees with equity. My name is Dominic Ball. I'm one of the tax directors at Pierce. I've a background in corporate tax advisory, with having worked with a number of firms before joining Pierce late last year. So my background predominantly in advising owner-managed businesses and corporate businesses. I've helped businesses with overseas expansion, reorganizations, and M&A activity as well. So today we are looking at employee incentivization, but first we'll just give those of you who perhaps don't know Pierce or are new to Pierce just a brief background upon who we are. So the Pierce Group is a full-service accountancy firm, but we have dedicated specialists in a number of specialist areas which you may not be aware of, that being a corporate finance team, which can help businesses source finance and deal with perhaps executing exit strategies, whether that's for a third-party trade sale or supporting management buyouts. We also, uniquely to the Northwest, have a well-established and long-established forensic accounting function, which provides support for shareholder and matrimonial disputes and solving sort of complex inquiry cases around disputes and contentious matters. Myself and my other co-director in tax lead the tax advisory service as well across Pierce, which supports businesses, individuals, trusts, partnerships across a number of different tax areas, and we offer a whole full service tax advisory function. Pierce has been established for over 90 years. We work with companies across a range of sizes, right from newly formed startups to well-established large international groups with turnover in excess of 80 million. We offer a fully partner-led service, so your key contacts, your day-to-day contacts will likely be one of the partners who will either lead with your day-to-day accounting services or supporting you on specialist projects. What you can expect from us in terms of, we tend to agree fixed fees up front, so you know and have certainty of the value that you're receiving. We will provide proactive advice as and when you need it, coming to you with our sort of preferred suggestions on how to support your business and help you achieve your goals, not just waiting to be asked the right questions. We really want to help businesses grow, and we want to be the partner that helps support them through that. In terms of the agenda today, then, we'll be looking broadly across different various forms of equity incentivization. We'll first start off looking at why do people use equity incentivization, what's the purpose of it, and why you should perhaps be considering it at this moment in time for your businesses. And then just going into a bit more detail about the various options that exist as well. So kicking straight off, we're looking at right into the benefits of equity incentivization. And really the key reason for many businesses that are looking to get involved or undertake some form of equity incentivization is primarily around attracting the right employees and retaining them for the long term. That's generally the key reason businesses are looking at giving away hard-earned equity to employees, and it'll be around the best ways in which you can help tie in your key employees for the long term and really drive value in your business going forward. And the key things that come with that then is increased productivity from these employees, as they often have a feeling of being more bought into the business, more aligned with the mission and objectives of the shareholders, which can lead to increased productivity, improved engagement. But the other key benefit, and particularly sort of pertinent at this moment in time, given what we're facing in terms of the pressures in the employment market, is that this is a really good way now of looking to differentiate how you attract those key members of staff with the different forms of remuneration structure, and perhaps a different form which, absent the initial setup costs, it has a sort of a nil impact on cash flow, giving away equity options or some form of share incentivization doesn't put any pressure on your cash flow at this moment in time. Yes, of course, it comes at a potential cost to your or the shareholders' long-term equity value, but hopefully the idea of a well-structured equity incentivization scheme would be that the shareholders will receive, albeit now a smaller share, but of a much bigger size of business, because you've aligned your key performers to help grow the business for the long term. So it should be a win-win situation for all those involved. The business should get more motivated employees. It should come at a relatively low cash cost, and everyone wins from the increase in business value in the long term. We're seeing these become more and more of interest to a lot of clients across different sectors, and these are very much just becoming commonplace in certain industries. I deal with a lot of technology companies that often employ developers and software engineers on six-figure salaries already. And the only way really to differentiate amongst them is to start giving away pieces of equity as well. So this is becoming more of a necessity in the technology space, that this needs to be offered to sort of the key developers within the business. So it all depends on the sectors you're in, what's right for your business, the type of scheme you want to introduce, and what you hope to get from it. All will tie into the best choice of scheme for you. But we're definitely seeing a lot of interest within the market from this. A lot of clients coming to us with different situations, and it's something that is definitely going to be of use, given the way the staffing market is at the moment. I'm sure most of you will feel the same pressures within your business of trying to attract the right talent. Getting the right people into the business is becoming harder and harder, and this is definitely something that will be of interest to you to help sort of change your remuneration structure to attract those best candidates. So now, just looking at the key considerations for different types of equity incentivization. Now, the main reason that we tend to look at this is because business owners, shareholders, want to provide shares to key employees to align them, align their objectives to that of the shareholder, to really tie them in. And we've had a number of clients over the past month that come to us and say, saying, can you help us just give some shares to the employees? I want to give up 5% of my equity to my employees. I say, yes, we can do that, but you need to understand what the implications are of this. And so if a company was to provide shares to an employee for free, whilst that may be great for the employee's perspective, it is likely to come with an unfunded, or they call a dry tax charge, in that the company will have an asset, but they'll also have a tax liability, but not necessarily the cash to settle it. So in this example, assuming you wanted to give shares worth a market value of £100,000 to an employee, that will likely come with an income tax charge of £45,000 at the additional rate, assuming that they are perhaps at the higher end of the remuneration pay scale already. So that may not be something that the employee can actually settle. And it's important to note that there's a distinction between the tax of businesses and what the tax implication will be. So generally for unlisted companies, so the main owner-managed businesses that we deal with, this will be an income tax obligation on the employee. However, if the unlisted company has trading arrangements, so you have a market in which the shares can be sold. This could be, say, an EBT, or if you have arrangements to sell the business at the time you give the employee shares. So perhaps you promised an employee shares just before the business was to be sold, and you then gave them shares immediately before a sale. That would constitute trading arrangements, which would then create a POIE and NIC obligation on the company, which then in turn the employee would have to make good to the company, or otherwise it would give rise to a further tax charge on the individual as well. So there's a distinction between who bears the initial cost, but ultimately it's a cost to the employee. So assuming there are no trading arrangements, if you give £100,000 worth of shares to an employee, that'll be a £45,000 tax liability on the employer, which they'll need to disclose in their self-assessment tax return. So it might be great that you're giving them the shares, but it does come with a tax liability. And that's why we are looking at sort of different options, and why there's various options within the legislation to provide more efficient means to give employees shares, as the government recognise that there's often the need to align the interests of shareholders and employees to a common goal. And that's what the purposes of the different options are, which we'll be exploring today. So in terms of the alternatives, it's probably best to think of them in sort of two different categories. So you have options, which is essentially a right to acquire shares, and you have actual shares themselves. And so options can be broken down into two further categories: tax advantage schemes and unapproved non-tax advantage schemes. The main benefit of tax advantage schemes, being EMI or Csop company share ownership plan options, are that when the option is granted, the option will have at a price at which the shares can be acquired, and that exercise price is often the market value at the time the option is granted. Now, if the options are structured in that way, when they come to exercise it in a few years' time, when the company's value has perhaps risen, the value which the employee pays will still be the market value at the time of grant, but then that won't give rise to an income tax charge if they pay that value, because they've paid the value of they've paid the market value at grant, which would then not lead to any further income tax charge. Unapproved options are differ in that if the individual was to pay the market value at grant, there would be an income tax charge on the difference between the value of the shares at exercise and the price that they pay, being the grant value. And so that's the key difference, is being able to give employees an option to acquire shares at a value locked in at the current point in time, without an adverse tax consequence when they come to exercise that. On the other side, then, we've got shares, which can be another form of equity incentivization in themselves. So as we said, you can just give shares, and you could give the employees a means to pay for them, perhaps through loans from the company. This may have other tax consequences that would need to be considered if you did that, or the employees could simply just buy in, or they could accept the tax charge and just pay the tax charge. So ordinary shares are still an option, and it is something that we've supported clients with as well, who have just wanted to provide shares without options, without restrictions to employees, because that's what was agreed. Yes, we can facilitate that, but it's important to know there's tax consequences of doing so. A way around these tax consequences then can be to use what's called growth shares. And growth shares are a specific class of shares which have rights to capital over a specific hurdle. And the purpose of that hurdle then is to suppress the current value of shares, so that the amount that the employee has to pay at day one is then suppressed because of the rights attaching to those shares. So that was just a brief overview of the various options, which we'll then now just explore in a bit more detail. But before we decide, we go on to decide which one's right for your business. As I said, that there's various different options, there's various different considerations that need to take place, and it'll all depend on a company by company basis. There's generally not a one size fits all for this. That being said, for companies that do qualify for EMI, that's often seen as one of the most efficient forms of equity incentivization. But then that might be interplayed with perhaps growth shares because of different commercial factors which need to be brought into as well. So all these things need to be thought out in the design of an appropriate scheme to ensure that it is an incentivization feature for employees, and not just seen as a way to perhaps just cut salary costs. It needs to be seen as sort of genuine value to the employees for it to be an effective incentivization tool. So when designing a scheme, some of the things you'll need to consider is who will be part of this. Will it just be for a few key employees, or will it be for your whole employee base? What level and values of rewards will need to be made? in terms of how much equity do you want to give away? Is it just going to be 10% of the entire equity? Is it going to be an element of future growth? How do you want that to be structured? What fits best to you and your business and future growth plans? Do you want your employees to actually pay to buy into it? Do you want them to incur a cost to acquire the shares, or do you want these to be as sort of low cost as possible? This again will factor into the different choice of schemes which will need to be considered. And finally, one of the other options is, do you want to sort of link performance conditions to really further incentivize employees? Do they need to reach certain targets before they can actually get hold of equity or options? And these can all be brought into the different schemes in different ways. Now we're going to look at the enterprise management incentivization scheme. So I said this is one of the tax advantage option schemes, and my colleague Nazmin, who's a corporate tax advisor in our tax team, is just going to talk you through now the different requirements for the EMI scheme.
Good morning, everyone. I hope you're all enjoying the webinar so far. So EMI options. So what are EMI options and why would you want to choose them? So EMI options, essentially, it is a HMRC initiative that allows your business to be able to grant shares to employees that hold significant tax benefits. It's designed really to support smaller businesses and make granting equity an easy process. There's many tax benefits from it. Going through the first one, they're tax-free for employees. So if employees are granted shares through the EMI option scheme at their market value, then there should be no income tax and NIC charges. If, however, they're granted at less than market value, then there will be a small income tax and NIC charge on that difference. When the employees go on to sell their shares, there will be a capital gains tax due, which does usually qualify for business asset disposal relief, which means that the employee can then benefit from the lower rate of tax at 10%. And if they have their annual exemption available, then they can also use that. The annual exemption is currently at £12,300. It's a flexible criteria, which we will go through in the next couple of slides. And for you as an employer company, you'll be able to claim a corporation tax deduction as well. The deduction, it will be on the difference between the price paid by the employee and the relevant market value. So going on to the next slide, we've got an example. Yep, so in this example, Ben is granted EMI options to acquire a 5% shareholding in his employer company. So the market value is at £15,000 and he's been offered that. So 5 years later, he exercises the option and the shares are now worth £100,000. He eventually sells them for £150,000. So Ben, he will pay no income tax or NIC charges when the option is granted to him, and neither will he pay any tax charges when they're exercised. That's because they were all granted at market value. When he does go on to sell this shares, there will be capital gains tax due on the gain of £135,000. So that's the £150,000 sales proceeds that he receives, less the £15,000 price that he paid for them. Ignoring any reliefs, and if he qualifies for business asset disposal relief, or if he's a lower rate taxpayer, he'll be paying tax at a rate of 10%. So that'll be £13,500 on that £135,000 gain that he has made. And going on to the next slide, there are some conditions for the company. So as an employer company, you'd have to meet these conditions to qualify for the EMI scheme. The control condition is one of the main conditions. So the company issuing the EMI shares, it must be the ultimate parent company, and the subsidiaries below the parent company, they must be all qualifying subsidiaries that meet the legislation. The gross assets in the group, they should be less than £30 million, and the employees in the group, overall, they should be less than 250 employees. The company should be carrying on a qualifying trade, and nothing that's excluded. Excluded trades are such as financial services, accounting and legal services, and the company, it should be UK resident. The next slide goes on to the requirements for the options. So the requirements for the options, there's 4 requirements. So briefly, the type of shares, it should be ordinary shares that are fully paid up and they can't be redeemable. The 10-year rule is that they must be capable of exercise within 10 years by the employee. There should be a written agreement between the employer and employee made. So if you want to put any requirements down, you can put it down in the agreement, and it should all be written. And the employee should not be able to pass on those options to somebody else. The limit on the options is that you can give up to £250,000 per employee. But if they have Csop shares, then that does affect the limit and it will be reduced apportionately according to that. The 3-year rule is that once they use up those options and the limit of £250,000, then there's a 3-year, they have to wait 3 years until they can further exercise any more options. The 3 million maximum rule is that for the group or the company that you can use a maximum of £3 million for EMI options that you can grant to overall employees. And that's it as a brief overview of the limits. I think that's it from me, and I'll pass it over to Tom. Thanks.
Thank you very much, Nazmin. So yeah, as you can see from that, there's considerable advantages for employees and from an employer side to be able to give options to employees. And so the key things for EMI is the fact that there is this no income tax charge or NIC charge on the grant, on the grant and exercise of the options. So a very tax efficient way of getting equity into the hands of employees. But obviously this is often, you need the sufficient passage of time to do so. So it's great for growing businesses who are perhaps looking at a 5-year timescale ahead of a future exit or third-party trade sale. So it may be that's the time in which you look to consider this in advance of those, so that employees can benefit from that future exit. Now, moving on to the next tax advantage scheme, that's a company share option plan, a Csop. So this is a different type of option scheme, which comes with different criteria to the EMI scheme. The key benefits are, again, you can provide tax-free options to individuals. You can set flexible criteria in terms of what the employees need to do to be able to exercise the options. And again, you can benefit, the employer can benefit from a corporation tax deduction. So very similar to EMI. One of the key differences that Csops don't come with the same business asset disposal relief qualifying criteria. They will only, the shares in which the options are granted over will only qualify for business asset disposal relief if it meets the standard shareholding conditions, in that the individual has held the shares for at least 2 years, has been an employee or director for 2 years, and owns at least 5% of the shares in the company, has the right to at least 5% of the proceeds of a sale. So it's not like the EMI scheme, which has a different set of business asset disposal relief criteria, which specifically apply to EMI options. So it's one of the drawbacks for Csop, but the advantage of them is that the more applicability. So the industries that Nazmin mentioned were excluded under an EMI scheme, such as those in accountancy, legal, financial services, those dealing in property and land, Csop can then be a potential option, which you may want to consider. Now, again, just looking at an example about how Csops work. So again, Ben's granted the right to acquire 10,000 shares this time. The market value of the shares are £3 per share, and that's the value at grant. 3 years later, he exercises those options. The shares are now worth 130. So he thinks, yeah, right, I'm going to exercise these options. He pays his £30,000 and acquires shares worth £130,000 for it. At the time of the grant of the option, there's no tax charge. At the time of exercise, because he's paid the market value at grant, again, there's no tax charge there. But then when he comes to sell those shares, assuming he sold them immediately after, there would then be tax on the gain of £100,000. Again, if he met the conditions for business asset disposal relief, that would be at 10%. If not, which is perhaps most likely in these situations, because we tend not to have 5% of the company in a Csop plan, but it may be the case that we do. Then in which case the tax would be 10% if he qualified, or 20% if he did not. And so now looking at the conditions for the Csop scheme. So again, it's a tax advantage scheme. The main limiting factor here is the maximum value that can be awarded is £30,000. So that means the value of the options of which shares are granted at the time of grant must be £30,000. So in that example, that's why we gave 10,000 shares at £3. They can be granted to any employee or full-time director, but the employee or director must have no material interest, and that is no more than 30% interest in the business. The Csop can be over ordinary non-redeemable shares, and they must be acquired for the market value at grant, so that there's no flexibility in perhaps giving shares, granting options over a lower market value. It has to be at the agreed market value at the time of grant to be able to get the tax advantage treatment. And similarly with EMI, they need to be non-transferable. Now, we include this for completeness, but it's very sort of very limited circumstances in which unapproved share option schemes will tend to be granted, given that it comes with the tax consequences at the time of exercise. But again, it is a scheme which may fit some people in some industries. So the key things is that because it's an unapproved scheme, with no tax advantages, there's a lot more open and flexibility. There's no restrictions in terms of what trade you do, how much you can grant options over. You can set whatever conditions you want. So it's a very flexible scheme and very limited conditions which need to be considered within an unapproved scheme, because they carry no tax advantages. But it may just be a scheme that's needed for incentivization purposes. So you might perhaps do this where where an employee has used up his entitlement to EMI schemes, or the company doesn't qualify, and you want to provide the ability for the employee to participate in equity, but you don't want them to have a shareholding at day one. You want to give them the right to acquire at a future point in time, because you want to set conditions, you want to set performance objectives. And so this is where these may come in. But if the company was to qualify and it was appropriate to perhaps use a tax advantage scheme, they would likely be more the preferred option for both the business and the employee. This is in essence a backup option if there are no abilities to do it in a more tax efficient way. So how do these work? How are they different? Unlike Csops and EMI, there's no formal valuation required, because at the time you grant the option, it has no bearing on the tax treatment. The tax treatment is dependent on the market value at the date of exercise. So if at day one the shares were worth £10,000, and then when they exercise the shares they're worth 30, if they paid any less than £30,000 at that time of exercise, there would be an income tax charge on the difference between on the difference between what they paid for it and that £30,000 market value. So it works essentially the same tax treatment to just providing shares, but you've included the option agreement to give that employee some form of written agreement over the future right to acquire shares, which can be in itself a motivational factor rather than just promising shares in a few years' time. But again, these is really only for situations where the tax advantage schemes don't work for your business. So looking at an example, again, Ben is granted an option to acquire 10,000 shares at a cost of £3 per share. 3 years later, he exercises them when the shares are worth 130,000 for a cost of £30,000. So again, this shows that he's acquiring shares at below the market value at the time that he exercises them. So there's an acquisition cost of £30,000, and then there's a difference then of £100,000, which he's essentially received as an employment benefit. Effectively, he's received that value by way of his employment. So that's then charged to income tax. Assuming he's a higher rate taxpayer, that would give rise to a £40,000 liability that we need to pay. If it was then to sell the shares, there would be tax then on the difference between the sales proceeds at the time he sold them, less his acquisition cost, less tax suffered, and less any allowances. Again, this will be subject to tax at 20% unless he met the usual conditions for business asset disposal relief. Now, moving on to look at then just giving equity outright to individuals. So as we discussed right at the beginning, you can just give shares, but we know the tax implications of doing so would be to give rise to an income tax charge on the value of the shares gifted. Growth shares provide an alternative way of structuring the gift of equity or the provision of equity as an incentivization tool to employees. And the way they work is that you create a special class of shares, so perhaps a new A, B, C, D shares, and these shares will have specific rights attached to them, which allows employees to participate in the growth in value of a company over a pre-agreed threshold. That threshold will most commonly be the market value at the time the scheme is put in place, or a slight increase over that. Again, it will depend on how exactly you want the scheme to work for your employees. But the purpose of the inclusion of that hurdle rate is a means of then suppressing the value, because if those shares, if the shares had a hurdle of say £1 million and the company's worth £1 million, if those shares were given to the employees and then the company was subsequently sold for £1 million, the employee would then not be able to benefit in any of the sales proceeds because the value of the company hasn't exceeded that hurdle. So that means that the day one value is incredibly low because there's very little capital rights attached to those shares. And so the dilution of that sort of economic interest is a way of suppressing that value. So his tax charge on the acquisition of those growth shares should be nil on the basis that he would pay the market value for the growth shares, which would be a notional value, subject to the hurdle rate being set at the appropriate rate. So as we said, this just goes into a bit more detail now about how the share options work. They can also include performance-related targets within growth shares. This could be within separate agreements. This could be tied in with an EMI or unapproved option scheme as well. So you could give the rights to acquire growth shares through an EMI scheme or an unapproved scheme as well. So you could perhaps combine this with different schemes, or you can just give growth shares outright. And again, just to emphasize, the purpose of this is to suppress the initial value so that there's a limited or no tax charge at the point the employee acquires them. And this graph then just shows what the options of what growth share schemes, growth shares are trying to achieve. So you set a hurdle rate at the current market value, and as the company grows in value, the employees who then or growth shareholders will then have the ability to participate in a share of that future growth. The share of that future growth again can be flexible, different schemes for different purposes. In family situations, you may set growth shares where the entirety of the growth goes to certain family members. This may be for estate planning purposes, but in more employment incentivization purposes, you may be looking at sort of giving 5% of the future growth or 10%. The percentages can be completely flexible. And what that means is that it ring fences the current value of the company for the existing shareholders. So that means at the points in which the growth shares are issued, the existing shareholders will always get that hurdle rate to themselves. So there's no dilution of their of the equity value that they've built up to date. The growth share participants then only share if there's any increase in value over that hurdle, and they can split that between existing shareholders and the new growth share participants. So in terms of how these work, again, if they're structured appropriately, there's no income tax or NIC charges when the employee acquires the shares. That's because they will acquire them at market value, and the market value would be suppressed due to the hurdle. Now, one thing to note with these is that unlike EMI schemes where you can pre-agree a value with HMRC by submitting a formal valuation request, you can't do the same for growth shares. So it's very much reliant upon a third-party valuation, which we would do on the company's behalf. We would prefer a company valuation, which would in turn set the hurdle rates to determine the future growth participation rate as well on the shares. Now, the thing to know is that because that's not pre-agreed, there's no guarantee that HMRC will take the same approach with that valuation. So it's one of the downsides to growth shares. But so long as a robust valuation methodology is followed, it should be that HMRC would agree to that. And we've implemented these schemes for a number of clients on this basis. So very importantly, to get that initial third-party evaluation of the company to set that hurdle rate. And then we draw up the legal documentation. We perhaps get things in place in terms of, if you don't already have one, a new shareholders agreement, which will protect the rights of existing shareholders. Again, that's a key part of any of these options, really, is to think about protecting existing shareholder rights. So that needs to be thought out. But even more so with growth shares, because unlike options, when you give growth shares, the employee or individual in which you've given them to actually then has ownership of the business. When you give options, they only have a right to acquire future shares. So with options, if you were to leave the business, it's generally that those options will then lapse. So there's just no ability for them to acquire shares if they leave, unless you specifically write into the articles or a shareholders agreement that there's conditions of forfeiture for the growth shares, then the employee will continue to own them. So it's very important to make sure that you put these conditions in place, that if an employee was to leave the business, that they then have to return the shares, or the company buys those shares back at the price they paid for them. So essentially, they get no benefit if they leave the business. They only can benefit from the growth shares if they were to stay with the business for long term and meet the conditions which are agreed in the setup. Now, looking at example in this case, so we've got a company worth 5 million. It wishes to award 10,001p share. It currently has 10,001p shares in issue, and it wants to grant to an employee 25% of the issued share capital. So the company then agrees to issue a further 3,333 shares to give him 25%. And these shares then issued at perhaps a slight premium over par, i.e. 20p. And the reason we issue it at a slight premium over par is to reflect the future hold value. That will depend upon the nature of the business, at what level that's set. Generally, a slight premium over the par value of the shares is set, and that gives a very small notional acquisition cost, in this case £666. Then based on the valuation, there's a hurdle rate attached to it that reduces the value of the shares to this par value, or a slight premium over par. And then when they come to when they come to then sell the shares on perhaps a future exit, they'll then participate in the growth. So in this situation, the company is worth 5 million. That's set as the hurdle rate. So on a future sale of 7.5 million, the first 5 million is then returned to the existing ordinary shareholders. They've maintained their existing capital value. And then the 2.5 million growth is then split pro rata. So you've granted 25% of the issued share capital to the employee, so they'll benefit from 25% of that growth of that 2.5 million, which would be £625,000. So then if the employee was to then sell those shares, they could then sell them, realised sale proceeds of £625,000. It would be less their acquisition cost, just a slight mistake in that table. It should be 666. Again, it's just a notional cost, which would then realise tax on sale of 62,000, assuming it met the conditions for business asset disposal relief. It's important to note that with growth shares, just because you give, say, 25%, this might not automatically meet the conditions for business asset disposal relief if that 25% didn't entitle them to 5% of the sales proceeds. So it's not always the case that growth shares will qualify for business asset disposal relief. It'll all depend on the company value and how much is given to the employees. So it's slightly more complicated than just looking at what percentage is given to the employees. It's actually how much of the sales process can they participate in. So again, it may or may not qualify for business asset disposal relief. As you can see, significant cash advantage to the employee and very limited tax implications in doing so. Now, just to wrap up then the schemes that we've been discussing today. So we've got EMI schemes. These are a tax advantage share scheme. So they come with the ability to provide employees a right to acquire shares at a future point in time. And at that future point in time, if they paid the value of the shares at the time, if they paid the value for the shares at the time that the option was granted, then there'll be no income tax and national insurance to pay. And there's a number of conditions as we met of different eligibility criteria, which if a company meets, then this may be an appropriate scheme for them. It also has the advantage that advanced clearance can be sought from HMRC so that you know there's going to be no unintended tax consequences on the employee because we've agreed that valuation in advance. Similarly, CSOPs are a tax advantage share scheme again. Again, they come with no income tax and national insurance contributions provided that the employee pays the market value of the shares at grant. Again, that's a condition for CSOPs to actually qualify for the tax advantage treatments that would be necessary. And unlike EMI schemes, there's no limits, but there are limits in terms of the amount of shares and the value of shares which can be provided up to that £30,000 limit. Unapproved options, again, may be something to consider if tax advantage options don't fit the scheme which you're trying to set up. But generally, if you're looking at unapproved options, it may be that growth shares are perhaps better from a tax perspective, and it may be better to look at considering growth shares as over an unapproved scheme, unless you're happy to just bear the tax cost of an unapproved scheme. So as you can see, various options to consider, different pros and cons of each one, and which one fits your company, your circumstances, all depends upon your individual facts. It's very much that a consultative approach. There's not a one size fits all, although there are certain key advantages to some over others. It's very much designing a scheme which works for your business and works for incentivizing your employees. There's no point putting in place a scheme which doesn't have the desired incentivization effect. So it needs to be well thought out from the start to ensure that it has the desired advantages in terms of giving away equity, in that it is actually seen as a tool to retain employees and to incentivize them to grow the business further. So I'd just like to just end now. That was everything that I wanted to cover off. If anyone has any specific questions, you can either drop a question in the chat box or unmute yourself to ask the question and we can discuss that now. Or if you want to arrange a call just to discuss any specific facts to your business after, happy to do so, and I'll share my details at the end slide. Great, thank you very much, everyone. Unless there are any questions, I'll close the webinar now. My details are on screen, so please do take a note of these. Lauren will also share the slides, a copy of the slides after this presentation for future reference. But please do reach out if there is anything you want to discuss, and if we can support your business in any way, we'll be happy to help. So thank you very much. Thank you very much for your time today, and look forward to speaking to you soon again.